how do you see the setup as we head now into the say back half, but the waning months of the year?
Right. So didn't we just have a record high yesterday? What was it, yesterday, the day before?
That's
How many
why
record
we're
highs?
not making too much of this decline.
Yeah, no, I'm just saying, but let's put it in perspective when you start. That's what I do. I pull the lens back and I say, look at where we've come from. Look at that sell-off that we had in April. Look at how fast that we regained that sell-off. It was the fastest in history that we bounced back. Out of all the markets in historic fashion, we bounce back quicker than any of them.
The show is called Fast Money.
It is. It is. So when you really look at how these things collapse on each other, you have bull, you have bear markets that collapse on each other. They cycle through really quickly. I think we're going to have a little bit of temporary weakness in September, maybe for about 2 weeks or so. And then depending on how those pan out, do we get the rate cut? Big for me and big for the market, whether or not we get that rate cut. And I think people are starting to hedge their bets. They were leaning towards that 50 basis point. Maybe they're going to get 25 basis points of a cut. They're getting a cut, in my opinion. And then I think we get back on the horse late October.
Okay. Julie Beal, you've been hot on the small cap stocks for a long time. We've got new record highs on every major average except the Russell 2000. It is not quite back to where it was last November. Do you remain optimistic? And if so, why?
Yeah, absolutely. It's been on a pretty persistent losing streak, but it's justified. You know, the earnings growth for the Russell just really hasn't been there. It hasn't materialized. You can find great small cap companies that have had great earnings, but the index overall is still 40% non-earners. So it doesn't surprise me that it's been a persistent underperformer. This rotation is interesting, though. It's clearly based off of value and people chasing a lot of the more cyclical value stocks, feeling less worried that we're going to see a lot of tariff fallout. And I think that's fine and probably a fairly reasonable position to take. But this is an area where people have been playing mostly passive. And I think that outflow happens very, very quickly, just as quickly as the inflow happened in August.
Yeah, you know, Mike Coe, listen, historically, September, if we go back to Guy Adami's birth year of 1928, he's not here to defend himself. If we go all the way back, you notice that the S&P 500 has fallen about 1.1% in the month of September. Then generally we get some kind of a little rally heading in to the new year. So we got a rough historical setup. We got a VIX that's at 14, implying almost no fear or options volatility. And yet we've got a fight over the Fed, which we'll get to in just a second. And we've got a tariff situation that is still cloudy. How does Mike Coe see the setup going into the next couple of months?
Yeah, I mean, the first thing I would say just about today's weakness, I mean, we're coming in, it's a fairly thin day. We're going into a 3-day weekend. I'm really much more interested in what's going to be going on after Labor Day than in the 24 hours that precede it. You know, it is interesting as we look at the VIX where it is. That's basically the S&P options markets forecast for volatility over the coming 30 days. And, 15, a little bit higher than where we were earlier this week, but certainly not very woolly. Now, one thing I would point out, September is a slightly above average month in terms of volatility, October even more so, and interestingly, November as well. But an important thing to remember, and this applies both to your statistic with respect to the returns and my statistic with respect to volatility, and that is that, pullbacks in the market and also increases in volatility tend to have a disproportionate effect on the average because they tend to swing a lot. If the VIX is typically 15, 16, and suddenly it goes to 40, that has an outsized effect on the average. Similarly, when you get some kind of a pullback, and September and October, unfortunately, happen to have been the months when a couple big pullbacks took place, it throws the average a little bit. Over 30 days, the average return for the S&P is probably in the neighborhood of 60 basis points over the long term, and more recently, significantly higher than that, of course. And right now, I still think the setup is pretty good. Like Steve, though, I think everybody's eyes are going to be on the FOMC in September, and if they get disappointed, that could see that uptick in volatility and the pullback that you just referenced.